Investing for retirement is a crucial step in securing your financial future. But where do you start? With so many options available, it can be overwhelming to decide on the best strategy. In this video, we'll explore the world of ETFs and how they can help you achieve your retirement goals. Understanding ETFs is the first step in creating a solid retirement investment plan. A beginner's guide to exchange-traded funds reveals that ETFs offer diversification, flexibility, and cost-effectiveness, making them an attractive option for retirement investing. For instance, a study by the investment company Institute found that ETFs have grown in popularity over the years, with assets under management reaching over $4 trillion in 2022. When it comes to choosing the best ETFs to buy, there are several factors to consider. Top picks for retirement investing include ETFs that track the S&P 500, such as VIEW or SPDR S&P 500 ETF Trust, which provide broad diversification and potentially lower fees. Additionally, ETFs that focus on specific sectors, like technology or healthcare, can offer targeted exposure to growth areas. According to a report by Morningstar, the technology sector has been one of the top-performing sectors in the past decade, with an average annual return of over 15%. Index funds versus ETFs is a common debate among investors. While both offer diversification and can be cost-effective, ETFs provide the added benefit of flexibility, allowing investors to trade throughout the day. This can be particularly useful for retirement investors who need to make adjustments to their portfolios. A study by the Financial Industry Regulatory Authority found that ETFs have lower fees compared to index funds, with an average expense ratio of 0.2% compared to 0.4% for index funds. Learning how to invest in stocks is a fundamental step in retirement investing. A step-by-step guide for beginners includes understanding the different types of stocks, such as growth, value, and dividend stocks, and how to allocate them in a portfolio. For example, a portfolio with a mix of 60% stocks and 40% bonds can provide a balanced approach to retirement investing, according to a report by the Securities and Exchange Commission. This allocation can provide an average annual return of 7 to 8% over the long term. S&P 500 investing offers a straightforward way to invest in the stock market. The benefits include broad diversification, potentially lower fees, and the opportunity to invest in some of the largest and most stable companies in the US. However, it's essential to understand the risks, such as market volatility, and to have a long-term perspective. A study by the CFA Institute found that the S&P 500 has provided an average annual return of over 10% since its inception in 1957. High-dividend ETFs can provide a regular income stream, which is particularly useful for retirees. By investing in ETFs that focus on dividend-paying stocks, investors can generate passive income and potentially reduce their reliance on withdrawals from their retirement accounts. For instance, the Vanguard Dividend Appreciation ETF has provided an average annual dividend yield of over 2% in the past 5 years. Dollar cost averaging explained is a strategy that can help reduce risk and increase returns over the long term by investing a fixed amount of money at regular intervals, regardless of the market's performance. Investors can avoid trying to time the market and potentially benefit from low average costs. A study by the Journal of Financial Economics found that dollar cost averaging can reduce the impact of market volatility by up to 20. With the right knowledge and strategy, investing for retirement can be a straightforward and rewarding process. by understanding ETFs, index funds, and how to invest in stocks. Individuals can create a diversified portfolio that meets their retirement goals. It's essential to remember that retirement investing is a long-term game, and patience, discipline, and a well-thought-out strategy are key to success, according to a report by the Employee Benefit Research Institute. Workers who start saving for retirement in their 20s can potentially accumulate over $1 million by the time they retire.